Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele. In studio with me, I'm joined by Ashton and Hechter, who both are from Anchor Capital. Now today we're talking Richemont, owners of several of the world's leading companies in the fields of luxury goods, with particular strengths in jewellery, luxury watches and writing instruments. Gentlemen, thank you so much for joining us today. Maybe if we walk through some of the brand names that are represented under the Richemont umbrella, it's the likes of Ralph Lauren, Chloe, as well as Cartier. So quite a few, and these are the things that we often like to admire and aspire to, right?
These are iconic brands, and you can't replace them with years and years of marketing expenditure. They've in many cases been around for hundreds of years. And I think that's what's attracted us to this business. There's a moat that's created around the fact that they own great brands, and great brands are often the best asset that you can own.
On that though, if we do take a look at just the overview of the metrics of the company, again, looking at the market cap, quite significant there, just over 500 billion rand. And the trailing PE, do we like that though? Isn't it quite expensive at these ratings?
It's been higher. I think that's the first point to make. This has often been well north of a 20 PE share, trailing 19 times. But I think that also misses the point. So within that number, you've got a lot of cash that sits in the balance sheet. So one of the key attractions of Richemont, you would argue, is that they've got, there's about 5.5 billion euros worth of cash in their balance sheet. So the valuation, when you take that out of the equation, is actually much lower. I think that you've got a very conservative management team that's worried about where they are in the global luxury goods cycle, and they're very conservative around holding cash back and not necessarily deploying it at this point in time. So.
You're quite right about the global reach, because whenever we read through the trading statements, all eyes shoot to China, as well as the exposure to Asia. Liam, is that a sore spot, or an opportunity there?
Well, I think in its history, it's provided both. It's been very fruitful for them. But over the last couple of years, I think that the growth that you saw in China was possibly at a very high base. It was possibly unsustainable. And once the gifting clampdown started in China, which is ultimately the Chinese government trying to stop bribery, you actually saw a big loss of demand for the products there, because ultimately they were being purchased and used to pay bribes with. So ultimately, possibly China was just a bit overheated, and we're not necessarily bearish on the outlook there. We think that possibly, we're not going to call the bottom on this one, but we think that going forward, this could possibly be now a base that you could grow off.
Having said that, though, we always hear about sluggish economic growth across the globe. We know that the US is picking up slightly, Europe's still going through its challenges. Doesn't this put pressure on the consumer, which in turn would add pressure to a company like Richemont with its sales? So
interestingly, you've seen a bit of a shift in demand. So I think China is still under pressure, and you're seeing negative numbers coming through there. Europe, funny enough, surprised on the upside, and part of that is dollar strength. So the fact that the euro has been weak has been quite good for their sales, because they've had a lot of consumers that have been traveling to Europe for tourism purposes, because their currencies are strong, and so it's very cheap to go and travel to within the eurozone. And tourism tends to be a driver of luxury goods spend. People feel good about themselves when they're on holiday, and that's when they tend to spend money. So one of the key risks, I guess, facing them right now could be terror related, and that you've seen the issues with Paris. So that's something we're watching quite closely. We think it could have a short-term impact, but ultimately the demand for these products we think will be enduring. And actually what's quite interesting is that prior to these incidents, is like I say, you've seen a big demand shift away from China toward Europe, but a lot of that could also be Chinese demand actually. So not the gifting Chinese that we see in China, but Chinese tourists traveling in Paris or the rest of France, wherever it may be, the rest of Europe. So it still could well be Chinese demand.
Looking back again at the most recent results, I understand that share price did take quite a negative impact on the back of this. Is this investors really punishing the stock for slight disappointment in numbers?
It was about an 8% miss relative to consensus. There are some moving parts in these numbers. There's big finance charges that occur within this business due to foreign currency movements. It's not actually real finance charges, because they've got net cash in their balance sheet. But ultimately it was a slight miss on earnings, or a fairly material miss on earnings. But I think that the bigger issue that consumers or that investors are looking at right now is the sales number. So we had the 5-month trading update, which people knew about, so there wasn't really any surprises there when they reported their numbers. But I think what scared the market, and that's, when you look at the half-year numbers, you had 15% revenue growth, but about 3% growth in constant currency. So obviously a big tailwind from currencies. So underlying demand growth is kind of 3%. But in October, it was down 6%, I think was the number. So people are worried a bit about what's happening in October. And I think there's an extrapolation being done throughout the rest of the year that this is now the new normal, which I think is premature to be calling that at this point in time.
If we do take a look at margin concerns, I understand that that's also an area where there are elements that could be at play, but I would think a lower platinum price would actually make it easier for them to take advantage of producing these luxury goods.
Absolutely. So we've owned one of their competitors as well in our global portfolios called Pandora, which has had a significant tailwind from falling commodity prices. So falling commodity prices generally create some gross margin headway for these guys. They tend to benefit from that because pricing tends to be stickier at the retail level, but so they don't drop their prices whilst they're getting declines in commodity prices. So your input costs are falling, so that's good for them. But I think the bigger issue is people are worried that they've gone from a 16% margin or 15% margin 10 years ago to a 25% margin today, and a lot of it was driven by Chinese demand, so sales leverage over fixed overheads. And if you see that slowing down, a lot of that can reverse. Now, I think a lot of it is structural in nature, in the sense that you've had a big shift away from wholesale toward retail in terms of their sales mix. So they used to, in the old days, rely a lot on the wholesale channel, in other words, selling their product through third-party retailers. But they've steadily invested out in owning their own retail stores around the world, and so particularly in China. Bricks and mortar. It's more capital intensive, but it also means that you're capturing more of the margin. So structurally, it's a higher margin business than it used to be. So I think there could be some margin downside with slightly lower demand, but we don't see this business going back to a 15% margin sustainably. I think the nature of the company has changed somewhat.
To sidestep for a moment, e-commerce, wouldn't that be a strategy that they could look at implementing?
Sure, and they have invested in assets to drive this demand. So they've got an investment in a business called Net-a-Porter Yux, which is ultimately an e-commerce portal to sell their product. Yeah.
Liam, I take it you like that? Naturally, it would obviously appeal as well to a wider audience across the globe.
Yeah, I think in terms of that merger that they did there, which was concluded, I think, about a month ago, what you'll see out of that business is some big synergies between Yux and Net-a-Porter, and they are now the largest online luxury goods retailer in the world. Another pleasing sign out of the merger was ultimately management's appetite to start doing deals again. And I think that with the large cash pile that they have, this is a management team with a proven track record of deal making, and we definitely back them to possibly, not go out there guns blazing, but certainly make some value accretive acquisitions over the next few years.
Having commented on the cash pile, there is a slide that we had up on the screen a moment ago, which again signifies how attractive this particular stock is, despite the cash pile that it has on hand.
So from a valuation point of view, I mean, you hinted to the trailing PE earlier on, but when you look at the share price and you break it down, so in euros, the share price is about 70 euros, bearing in mind the South African instrument is 1/10 of a euro share. So in euros, it's 70 euros. But there's about cash of €8.50 in that. That's the $5.5 billion euro number. And then they've got this investment in Net-a-Porter, which doesn't contribute much to earnings, but it contributes to value. So that's the listed value of that business trading separately, and their share of it. That's about €7. So you're paying for the operational business outside of Net-a-Porter, you're paying about €55 for this company, and you're getting close to €4 of earnings. On a forward basis. So it's about 14 times prospective earnings, which we think for the quality of the portfolio of assets that they own is a particularly attractive entry point.
You mentioned the South African listing, and I take it for any investor, we often hear how Richemont is spoken quite fondly of, given the wide reach as well as the currency benefits on the back of a depreciating rand. So for South African investors, this probably is a good one to invest in, given the broad reach and the currency benefits.
It's one of the better rand hedges out there, I would say, because they'll have more of a developed market mix and non-emerging market currency mix than many other listed assets in South Africa. So something like an SAB or a Richemont would tend to have more emerging market exposure than Richemont would.
Liam, on to piggyback off of the European recovery sales, we do have a slide on that as well, where, as Sean did mention a while ago, that there's been a significant recovery there. In the next 12 to 18 months, in your view, could that still be the powerhouse, or should we keep our eye out on China again?
Well, interestingly, what we watch in China is also how the consumer's doing there. So one of the indicators we look at is Chinese tourists and how many plane tickets they purchase to go overseas and where they travel to. Europe and the US are obviously the favorite destinations, and that's, as you can see in the results, where the growth is coming from. So we think that there's a certain amount of correlation there. The Chinese consumer, in our opinion, is doing fairly okay. It's the part of the economy that the ministers in China are investing in, and in terms of trying to stimulate, that's what we believe the growth will come out of in China.
Mm-hmm. Yeah. Let's get some of your views now with regard to Richemont as an investment choice: buy, hold, or sell. Sean, let's get your views on Richemont: buy, hold, or sell at these levels.
For me, it's a buy. I think there could well be a lot of noise in the share price. You may have to be patient, but I think this is. I put this in the camp of a great quality company, which is completely out of favor right now for various reasons. A lot of it is Chinese slowdown. There could be worries about tourism impact from terrorism globally. But I think ultimately they own a fantastic portfolio of assets. I think the margin downside is possibly overstated. And the valuation entry point that you're buying it in now is very low.
For the local investor trying to get in, try to get it below 100 Rand a share?
I think even at or around these levels, which it's probably trading at about 105 Rand, that's fine. I mean, that's we would argue that's good value.
Liam, you agree?
Yes, I do. I think you don't need to overcomplicate this one. I think if you look at it fairly simply, it's a business that operationally is at a forward 14 times earnings in euro. It should grow at about 8%, maybe 10% if there's a bit of currency tailwinds there, and with a dividend yield of about 3% in euro. So I think for South African investors on our market, that's a fairly compelling story. The management team is high quality, and they've got brands that are nearly impossible to replicate at the moment. So that sort of ticks the right boxes for us.
Exactly. You mentioned the European listing as well, but way easier to get exposure through the JSE instead of trying to take your investment offshore, right?
Absolutely.
Indeed. We'll leave it on that note for Talking Stocks this evening. Thank you for joining us as we get the buy recommendation on Richemont. A big thank you once more to both my guests, Sean Ashton and Liam Hechter, both from Anchor Capital. Do catch us again next time where we talk more stocks.